Is it possible, perhaps even probable, that economic data was manipulated in the quarters running into the election and we did have a mild recession from 4Q15 to 2Q16?
It's 100% probable that we had a recession on the industrial side of the economy. It already happened. 100%. That's why we made so much money for people from 2014 when the industrial profit cycle peaked to the low. I mean, if you go to, we had a recession. Why do you think that all the recession states voted for Trump? Isn't that a different way to say it? Rust Belt whiteys, I mean, that's what they voted for because they're in a recession. They're in a recession. Look at the industrial profit recession. If you go to, first of all, let's give people a little teach-in here. Let's go to slide 14. It's called cycles. So the cyclical stuff, the peak, they typically peak before GDP does. That's why we put the red line in front of the black line. The main line of the cycle is the black line, or the black curve, sine curves. So that peak, if you go to the next slide, slide 15, looks exactly like what happened. This isn't an opinion, this is a fact. U.S. industrial growth, ISMs peaked right where that red box is at the end of 2014. The stocks got hammered in addition to the data. By the time they started to bottom, people were in the fetal position along that stuff. And now it's trying to bake in that you're coming out of the red, that you're going to have a recovery. Okay? So it's not a debate as to why the people that voted for Trump. They were in a recession. They're still in a recession. They're hoping to not be in a recession. That's really the question. Can you get the Rust Belt states out of the recession? He's talking about 35% tariffs. I mean, there's a lot. That's his constituency. So it's an open question, but it's not a big blanket you could put over top of that answer saying, were we in a recession? Was the government making up the data to say that we weren't? No, absolutely we were, and that's where the votes came from. Got it? The bigger and broader question is, will we have a recession ever again? And hopefully we're on top of that if and when it's coming. The first quarter that in 2017 is going to be a quarter where a lot of people are going to start to ask that question again because we're at 0.7% GDP sequentially, which equates to 1.3% year over year. I'll show you that on the doodle in a second as you ask the next question.
All right. The next one here is, what's your best way to get long Japanese exposure? Currency hedged ETF?
No, I wouldn't hedge. I don't like to hedge that. I mean, I think the yen's going down and the Nikkei is going up, so it's pretty straightforward. We've built the do-it-yourself thing here, so we don't want to teach you how to walk. I mean, at the end of the day, you know what to do when I say the Nikkei. If you can find a security that represents what I just said, then you're going to know what to do. I'll find one. So just as a reminder, this is your sine curve of GDP growth. The peak of the cycle was 3.3%. That was Q1. I'll give you 2 seconds to remember because you've seen this so many times. 2015. Peak of the cycle. GDP slows to 1.3%. Q2, 2016. Okay? That was the low. We thought, and the market thought, it wasn't just us. I mean, anyone who thought that you'd have more of the same, which is Hillary, we thought that the economy could do what it usually does, which is slow to sub 1%, towards zero. Now, it doesn't matter what we thought. Trump wins, and the data actually has accelerated to 1.8%. See that? So it went like this, bloop, no recession for now. And then in Q1, it goes back down to 1.3%. Uh-oh, need a lot of tweets, Trump. When that happens, that'll be interesting because this will be read from Wall Street as a minus 0.7% headline GDP number. That's the way it's reported on a quarter-to-quarter SAR basis. So this is going to be fun. Get ready. I'm willing to work. Ready to work. I'll be here.
The most important thing about interest rates is not the nominal level of rates. It's about debt service ratios. And right now, both across the corporate sector and in the household sector, debt service ratios are nowhere near the area code of where they need to be for deleveraging phase to
They're very low.
They're as low as they've ever been. And for the household sector, they've been rising on the margin for the corporate sector, but they're still 500 to 800 basis points off of where they were prior to the last two recessions. So, we have some room to run on that front. And also, I would just caveat this by saying if interest rates are backing up, it's probably due to growth going higher and or inflation going higher, but most likely real economic growth going higher, which means incomes are rising. So
Yep.
debt service ratios could stay flat despite rates going higher because incomes of the household and corporate sector are rising. And as I pointed out in a note this weekend, corporate profit growth has actually started to recover. And you have wage growth tracking, or at least not the most recent month in November, but in October is at the cycle high on a year-over-year rate of change basis. So you have incomes growing, rates are going up because obviously the growth algorithm has changed, and if that's sustainable, then rates aren't really the issue that most investors think they are.
So Miguel, think about rates of change, okay, man? Basically, again, sine curve. Anything in life. Think about, I don't know if you're married or not, Miguel, but think about your relationships, like your potential, if you're looking like Darius is looking. They're always looking. Now, is after the first date, are you coming down here? Or was it a really bad date and you're going down in there? Is it improving or is it getting better? Okay? So when you think of the debt service ratios that Darius just said, you can put pretty much anything that you have a question on the continuum of a sine curve. It's all about the rates of change. These are the days of our lives. It's not about the levels. It really isn't about the levels. You can write a lot of books and get a lot of fanfare on mass market media just talking about absolute levels, devastation and disaster, just absolute statements and everything that you can find on Zero Hedge, it's there. But when you talk about the rate of change, again, if debt service ratios have come from here to here, that's good. What we'll be measuring to answer the question here, that's still pretty good in there from the all-time low. If you start to see this, the answer to your question in rate of change terms will be yes, that's a risk. But there's still plenty of likelihood that doesn't happen. So again, that's effectively the epicenter of being data dependent. Every single data point for a trending series of data you can find on here. Okay, so that's our job. That's what we do every day. We do it for literally every single thing.
Absolutely. And so a couple follow-up questions right now. He's asking him, does a deleveraging phase need to take place before we can have any sustainable economic growth that is longer than a quarter?
Well, we've had deleveraging. I mean, look at some of the deleveraging on the high net worth consumers. I mean, we showed you a series of charts. Most of the deleveraging in the industrial economy. I mean, CapEx has been negative for 22 months in a row. The deleveraging or releveraging of buybacks and all these other things, that we've delevered a lot of decisions that people would make with capital. We've levered people up, we get that, but there's been a delevering in rate of change terms on a spending basis. There's been a delevering of CapEx expectations. You can look at delevering in a lot of different ways. There's actually capacity for more leverage, and that's the point that Trump's trying to make, or that any really counter-cyclical spending guy with debt is going to make, is that at the low end of the cycle, we got a lot of capacity here to raise a lot of debt and spend. The government can spend as the rest of companies and individuals are deleveraging. Not all of them are, I understand that. But again, I think that it's not an easy question to answer on an absolute basis because there's really no absolute answer. There are a series of different companies and investment decisions that you can look at. They're either leveraging or deleveraging. It's not everyone in the same thing.
Yeah, and I would just add, the necessity for deleveraging comes on the, with debt service ratios rising to a point and at a rate that is really dangerous, then you perpetuate deleveraging. I mean, this is what really catalyzes recessions, or at least has historically catalyzed recessions. This has been a very unusual cycle, but to the extent that credit isn't growing as fast as it has in previous cycles, or at least prior to previous recessions, you can make the case that we have a little bit more runway to lever up as an economy, both in the corporate non-financial side and on the household side. So again, unless you're making the case that we're very late cycle, there's about to be a recession tomorrow, then the answer to that question is no.
Right.
No, we do not need to delever to have incremental growth from here. Now, we obviously are somewhere between very late mid-cycle and somewhere in the later cycle part of the business cycle, but where we are is it's come under the question over the last few weeks, and so now we're doing the work on maybe recalibrating where we might think we are on the sine curve.
Yeah, let's go back to the sine curve one more time because this can help you answer. I'm gonna draw this every day. So if this is the Maginot line, this is 0, okay? Let's call this 0%. If you could have a cycle, obviously, that you go below 0. That's basically all of industrial production growth. Look at slide 15 in the slide deck. I'll just show you one that went from here to sub-0. Check that out. I think it's 15. Yeah, see that? See where actually we should have red, a sea of red instead of blue, but you get the point, okay? Industrial production growth peaked. We talked about this yesterday. I'm just going to keep reminding you because, again, it was a great time to sell all of your industrial holdings at the end of 2014 when, by the way, total U.S. corporate profits peaked. So, again, that went to negative, okay? So that chart is basically back to this. That chart got very, very negative. In rate of change terms, it was 2 years down to here. Got it? Real simple. The mainline cycle of GDP is not doing that currently. There's always a chance, actually, in using any historical metaphor, almost 100% of the time that industrial production growth does that, you end up getting a recession. It broadens out it manifests into a broader recession. What we have now is basically this line stopped at 1.3% year-over-year growth. The peak was 3.3% year-over-year growth, Q1 of 2015. This was Q2 of this year, Q2 16. You know, my friend Rich Bernstein, who's been always bullish and said growth is fine, completely missed this. A lot of guys miss this, right? You go from 3 to 2 to 1. If you missed it, just tell people you missed it, and then you got lucky with Trump, okay? It's fine. I mean, it's just tell the truth. In as much as the truth currently, according to our model, is that growth went to 1.8%. See that? That's it. That's the current truth. And we have it going back to 1.3% in the first quarter. I had questions about this yesterday.
1.4.
Year over year?
Yeah,
1.4. 1.4? Mm-hmm. So Darius just updated the model. 1.4. Mm-hmm. Okay? That's not a recession. Nope. It can look recessionary on a sequential basis because the way Wall Street looks at this, going from 1.8 to 1.4 is negative 0.7% growth. So when you heard me, I forget which person was asking me on Twitter, when you heard about the negative GDP number, that's what I meant. Q1 of 2017 will be a negative sequential. You go up, then you go down a little bit, 0.7%. How the market, by the way, you won't get that number till really April. So you got a lot of time and space in between Trump's coronation and then. So that's the current truth. It's not a projection going back to what happened from here to here, nor do we think that this is an accurate projection going from there to there. What we could say is that with 100% certainty, we are uncertain about what the forward path is after that. That's why we get up every day at 4 in the morning to measure and map it.
So process question, or actually a compliment in a question. The process videos you do are very helpful. Have you done any videos on size, like kind of a general template in terms of sizing or money management techniques? And if not, would you be willing to do some version of that?
I'll go for one. Who asked that question?
Let's see. Question from Steve C.
Steve, and by the way, I do appreciate it when I got to find some markers. They're hiding me from these markers. They're trying to get me to use their blackboard. It's like a little internal debate. I like these. But Steve, I appreciate, what I was going to say is I appreciate it, Steve, and otherwise. Like when you use your real name, I have to use mine. I think it's important to, I think it's a great question, first of all. I get asked this question all the time in one-on-one meetings with institutional accounts. In particular, when I get an analyst who is, a lot of analysts that are kind of my age are becoming portfolio managers now. So they've been in the business for 15, 20 years, and then they get it promoted. Once you're a good analyst, that's I'd say one risk in Wall Street is that if you're a great pitcher, then they'll make you all of a sudden the back catcher, and it's a different job. So I often get asked, can you teach me a little bit about sizing and timing? Like I love your timing signals. A lot of people say timing doesn't work, and you Keith always agree because a lot of people aren't good at it. But if you do have a process for timing, can you help me with sizing? So here's a real basic one that I use, in particular for guys that are being tasked with, if they're a rising star as an analyst and they get their own hedge fund book. So in other words, they're going to run the portfolio and then hire analysts. So it's a bit of a role reversal for them. So if you have longs and you have shorts, and I'm going to use the percent of your portfolio that is in your long and shorts. One really simple rule of thumb is that your longs should always be bigger than your shorts. Okay? That's one. That's the most fundamental thing that most short sellers who want to be great at it should understand is there's a central tendency of markets to obviously go up, so make sure that you're adjusting for that. So what I like to do is I rank by order of conviction my positions. 1, 2, 3. Is it a great idea? Are you making your portfolio great again? Is it a good idea that could be great, but you're not there yet? And is it one that you think will work? It's not any of these things. These are more like trading positions. So as a percentage of my portfolio, I do the 6, 3, 1 setup, okay? My max position is 6%, so percentage is what we're focused on here. 3%, 1%. So again, you'll note that I'm working, I like to work in thirds. I got 3 different kinds of positions, so I'm characterizing my positions. You know what? Portfolio managers that have like positions 4 through 19, this stuff doesn't really, A, contribute to your portfolio, and B, distracts you a lot. That's why when I ran money, I always had my top 10 positions were always some significant percentage of my portfolio, i.e. greater than 50%. So I'd want to get paid on my best ideas. I didn't want to hug the bench. But again, I go 6, 3, 1, and then here I basically cut these in half. So again, you got 1.5 and a half. So these are the percentage, okay? That's a 0.5%. So again, they're half. My top short is half the size of my top long. These are beta adjusted too, by the way. I don't want to get into that. It's adds a little bit more complexity to it, even though it's not that complex. But 6, 3, 1, 3, 1.5, half. Okay, that's the setup. I'm 2 times bigger on my best idea long versus short all the way through. I know what I'm doing. I know how I'm characterizing and classifying my positions. And then finally, we could do I'll do a whole meeting with institutional managers on this. But finally, when I touch the portfolio, it needs to be touched that way too. So every day, and again, I only learned this by screwing it up multiple times, and multiple times, and thank God it was with other people's money. That's what they do. When they promote you to PM, it's not your money you're running, it's other people's money. So you can screw up all the time, and it doesn't actually hurt you until you get fired. But I did screw up a lot. Fortuitously, I didn't have a lot of screw ups in the early years. That's why I kept getting more and more capital. But the reality is that one big screw up you can make is not touching the portfolio the same way every time you touch it. Okay? Think about that. Think about brushing your teeth. In the morning, if you decide to use the other hand all the time, tell me where the toothpaste is going. So the reality is that I want to have some kind of discipline here so that if Lockheed Martin's down yesterday, and I have Lockheed Martin right here, well, what is my rule? When I add to a position, what do I add? My add to positions in my portfolio would be 100 basis points. I'd add to it. If I decide to add to it, I'm going to add at least 100 basis points. If I add to a short, it's going to be 50 basis points. So again, if I have a short position that's a 0.5% that's going the wrong way, but I still believe in it, then I'll make it a 1% position. Then I'm working towards a 1.5. So if it goes up the next day, I've averaged in twice. Okay? Does it make sense? These things make sense? Yep. There's a discipline to how you should make your decisions so that when you hit that portfolio with your decisions and emotions and all that human stuff, which is really the biggest risk, you should do something that basically forces you not to be radical. The reason why, by the way, I thought of that was because I'd watch other PMs. Literally, they'd come onto the desk. I can't tell you what fund, but we had multiple PMs on the platform. I was the youngest one. And they'd come in there, and I would spend a lot of the summertime just in the office right beside the desk because I'd love to listen to the other PMs, how they made decisions in here. Because I'm disciplined to a fault. I eat the same thing. I get up at the same hour. I do this. The only thing that changes with me is I keep getting fatter, which I cannot. I can work on that. But the reality is that I'm a big discipline guy. I realize that my bandwidth intellectually or physically is constrained. So I have to beat people with discipline, hard work again. So these kinds of things, I'd watch them come in. It's turning into a bit of a rant, by the way, not surprisingly. They come in and they go, John, buy 100,000 shares of IBM. And then the other side come in and say, hey, John, short 50,000 shares of Exxon. John, another guy come in, John, buy 150 more. They literally wouldn't strike their portfolio in percentage of capital. They just come in and buy a big share lot. Just FYI, if Exxon's trading at 70 and some other things trading at 2, buying 50,000 shares of the same thing is not the same. I mean, it's not even. That's how bad a PM can be. You could see PMs are that bad because they're just like, oh my God, this thing's down. I got to buy another hundo. Whoa, you better be really good at that Because you're really moving, your capital's moving as a percentage of your risk, not in basis points of risk, and it's not calibrated and it's not disciplined. That's where you could really screw up. And this is where I see guys like, in particular, activists get into trouble because they're just like, buy another 100, buy 200. And before you know it, it's like 14% of their portfolio. There was never a 14% in my plan to begin with. Hopefully that helps.
So regarding your bullish trading ranges, it just helps to explain the process. Do investors add to positions as long as higher lows and higher highs continue? And conversely, if lower highs and lower lows start to occur, do you start to sell more?
If it breaks trend and the research corroborates it. So again, if you have a bullish trend, the channel in that, if you look at a 30-day channel, again, if you're trading it, so that's why I call it 3 weeks or less. So let's say in the next 2 to 3 weeks, if something like, I'm gonna doodle over this a little bit, but if I have something like this, which is like XLI, which is basically undergone from here to here, from here to here, the signal corroborates this. So now, as opposed to this being bearish, it went into a bullish, what we call bullish trend. What you do with an industrial is you sell it here, buy it here, sell it here, buy it here, sell it here, buy it here. And if you can do that with 100% batting average, then you call 0.72 and you tell Steve Cohen that you can do that because he wants guys that can do that. That is possible to bat 65, 75% doing that. I can assure you, and I can't assure you why without telling you that there is a very good process to bet on bullish trends on pullbacks, fading the market. It's called fading the market. Don't buy the highs, buy the pullbacks. That's exactly what we did with the NASDAQ 3 weeks ago.